Hi, I'm Helen Cowley, tax partner at UHY Happy Young in Manchester. This is the second in a series of videos I'm recording on international trade and investment. Hopefully you caught my first one, which was a brief introduction to the international services that I provide. And today I'm going to be looking in a tiny bit more detail into establishing a presence overseas. So that is doing business in an overseas jurisdiction rather than doing business with an overseas jurisdiction. Quite often business owners will be given choices of a legal form to operate their overseas trade, and typically they will look at a branch versus a subsidiary. And there are lots of legal, tax and commercial considerations to take into account when deciding between the two. So to start with the legal considerations, a branch will simply be an extension of your UK company. So that means that the liabilities extend to your UK company. And that also means that your UK company is potentially exposed to legal claims in the overseas jurisdiction. Now that risk can be ring-fenced somewhat by setting up a subsidiary of your UK company. So that would be a separate legal entity and the liabilities would not extend to your UK company. A couple of other things to think about is whether or not you will need some sort of local representation. So a lot of countries will require a branch to have a local representative or a company to have a statutory director who is resident in the country in which that company is incorporated. From a tax perspective, a branch would pay local corporate income tax on any trading profits or other profits it generates. Now, a subsidiary is slightly different insofar as it would be taxable within the jurisdiction it's registered on its worldwide profits, but in reality, those profits are likely to just be limited to the trading profits of the operations carried on in that country. So it's pretty similar to a branch in that respect. A few differences on the filing requirements. For a branch, your UK company will need to register with the local tax authorities, file tax returns there and pay the corporate income tax on its branch profits. A subsidiary, on the other hand, being a separate legal entity, will register itself for corporate income tax and to file tax returns. Now, because the branch is an extension to your UK company, that means that its results are brought within your UK company tax return. So any profits are taxable in the UK. However, double tax relief will ultimately be available in the UK on any overseas tax suffered on the same branch profits. Now, other tax considerations are what to do with start-up losses. With a branch, your UK company will get immediate tax relief on any branch losses. With a subsidiary, though, tax relief will only be obtained when the subsidiary starts to generate some profits of its own. Another point to consider is withholding tax on certain income that is paid from a subsidiary up to its UK parent company. A lot of countries will apply a withholding tax on the likes of dividends, interest and royalties. And occasionally, some countries will also charge withholding tax on branch profits, so that's on top of the corporate income tax that has been paid by that branch. Now, the UK has concluded double tax treaties with over 130 countries in the world, and within those tax treaties there are often provisions that deal with these withholding tax charges, and they apply in different circumstances a reduced rate of withholding tax. So withholding tax could be 15%, say, in the overseas jurisdiction, and the double tax treaty may reduce it to 5%, or may even give complete exemption from withholding tax through the participation exemption. If that participation exemption is not available, then there can be some tax leakage on the payment of dividends from your subsidiary up to the UK parent holding company. This is because the dividends won't be taxable in the UK, and therefore there's no UK tax to offset the withholding tax against, and that withholding tax then becomes a cost to the UK company. A couple of other things to think about from a tax perspective are any local employment taxes, because the chances are you will have boots on the ground, so you'll be hiring local employees and you need to know what the payroll requirements are there. And also any sales tax or VAT registration requirements, including what the threshold is before you have to register for VAT or sales tax. And of course there are always commercial considerations to take into account. One is the administrative costs of a branch versus a subsidiary. In all likelihood, there will be additional costs incurred with a subsidiary because it's probable that its statutory accounts will have to be audited, so that can incur additional fees. And other things to think about are your customer preferences. Quite often, local businesses will want to do business with a company that is registered in the country where they are located, as opposed to a branch of a foreign company. And finally, it's quite important to appreciate, I think, that in many cases it's relatively easy to register a branch to begin with. That way you may obtain your tax relief on any startup losses, and then you could later incorporate that branch into a separate legal entity, a company. It's important to be very careful that no tax charges are triggered on such an incorporation, so it's really crucial to get local advice in that respect. But of course, if you're considering establishing a presence overseas, then you will be looking at speaking to your UK advisors and reputable overseas advisors, and you will expect them to work together in advising you on the best structure in your particular circumstances. Thank you.